15 and time to take a look at your money here on Good Morning Quad Cities. But first, let's get a look at your weekly stock market recap. The S&P 500 down 4.6%, the NASDAQ down 4.7%, and the Dow Jones Industrial Average down 4.4%. And last week's big decline on the stock market was triggered by some comments made by the Federal Reserve Chairman Jerome Powell. On Tuesday and Wednesday, Chairman Powell delivered his semi-annual testimony before the U.S. Senate Banking Committee. And joining us is our financial expert, Mark Grywacheski from the Quad Cities Investment Group. Good morning.
Morning to you. Happy Monday.
Happy Monday, the day after daylight savings. So thank you for joining us on National Napping Day.
Oh, I'm struggling. I'm struggling.
We're on all the coffee here. But let's talk more about these comments that were made by the chairman. So, what was said and what does it mean for the stock market?
Well, even though the Federal Reserve didn't create this inflation, it has that very unenviable task of trying to get it under control. And its main tool is raising interest rates. The Fed hopes that by making it more expensive to buy goods and services on credit, that it inherently reduces consumer spending and thus kind of helps keep rising prices in check. Now, last week during his testimony towards the Senate Banking Committee, Federal Reserve Chairman Jerome Powell made two very significant statements.
Okay.
One, that any return to that 2% target rate of inflation we all want to get back to will likely be a very long and slow process. And second, most likely the Federal Reserve will have to keep raising interest rates much longer and faster than Wall Street was originally hoping for. So the longer we have this high inflation, the longer we have these rising interest rates, the greater the odds of a recession and the greater the potential impact to the U.S. labor market. And all that anxiety by Wall Street is being reflected in, as we just saw, that near 5% sell-off in the stock market last week.
Well, then I guess the question that I know I have and you probably have at home is why the Federal Reserve would continue to raise those rates if we're seeing more of a chance of a recession.
Yeah. Well, look, the Federal Reserve argues that this high rate of inflation is simply not sustainable. For nearly 2 years, consumers have been struggling with rising prices, especially in everyday basic necessities. Last month, David, listen to this, 92% of the monthly rise in inflation was caused by the rising costs of food, shelter, and energy prices. So the Fed argues that, yes, these rising interest rates will cause some level of pain to the consumers, the labor market, the economy, but that pain would be much, much greater if the Fed were to simply allow this high inflation to continue.
Just to kind of run off. Yep. Well, we're not only just seeing those interest rates rise, we're also seeing unemployment rise, going from 3.4 to 3.6%. Yep. So does that concern you at all?
Well, in February, that February employment report was a little bit mixed. In February, the economy right here, look at this, did add 311,000 new jobs, above the 223,000 that Wall Street was expecting. To your point, the unemployment rate did rise from 3.4 up to 3.6%. Wall Street, however, was hoping that unemployment rate would remain unchanged at 3.4%. Now, as the economy does kind of continue to cool down over the course of this year, Wall Street is already expecting this unemployment rate to rise from, the current 3.6 up to, 4.5, maybe 5% range by the end of the year. But for every 1 percentage point increase in the unemployment rate, for example, David, if the unemployment rate rises from 3.6 up to 4.6%, that translates to about 1.6 million Americans having lost their job.
Wow. Well, we can't let you leave this morning without talking about the big news that came in over the weekend with Silicon Valley Bank, another bank in New York, facing big issues, collapse there at Silicon Valley Bank. Does that concern you at all?
The collapse of Silicon Valley Bank wasn't really caused by some structural flaw or weakness in the banking or financial system, but from the fact its management made some extremely poor decisions. The management of Silicon Valley Bank made this massive trade that interest rates would not rise. And obviously, over the past 12 months, we've seen interest rates absolutely skyrocket.
Correct.
In fact, it's been the most aggressive pace of interest rate hikes by the U.S. Federal Reserve, going all the way back to 1980. So to cover all of these losses, we're kind of hearing some news out of the White House last night. Treasury Secretary Janet Yellen said the government would step in and bail out the Silicon Valley Bank. And so I don't see any risk of contagion at this point to other banks within the financial system.
Okay, because I know that was a big concern. A lot of people saying maybe you got to move your money here, but you're saying let's just calm down. This did happen, but things are going to get rectified here.
Yeah.
So.
Well, remember, FDIC insurance protects your deposits up to $250,000. Anything above, now the White House will step in and insure those deposits above $250,000.
It's great news for those of us that have more.
Diversify your banking system.
Yes, don't always rely on one place. Thank you, Mark, so much for your expertise this morning. And